Hey there, William. This is Johnny, DayTraderRockStar here, and I'm actually recording this video for you because there's probably so much information I couldn't type it, and I just feel more comfortable talking on the video. And I figured, also with your permission, I'd probably like to maybe share the video because it's a great. You have a lot of great questions, and I love you. I love your story. So, get back to me on that. Other than that, we're going to go into your email here. If you don't mind, I want to read the email just in case I do play this back. It says, Dear Johnny, I'm writing this email because I really need your help. I've been on and off subscriber for several years. I've been studying the markets for over 4 years, and even though I've learned a lot, I'm still not as profitable as I should be. I've read so many books and even took some courses with Pristine, but still cannot find my exact groove in the market. I have a very well-written trading plan. I'm very disciplined in doing my research and maintaining a routine. One of my weaknesses is being a perfectionist. I recently received Trading for a Limit by Dr. Alexander Elders, and I'm just about finished reading it. I'm at the point now that where I know I need to improve something, but just cannot figure out what it is. I'm really hoping you could give me some guidance and help me become the trader I am meant to be. Here's some information about me. My wife and I have just had our first baby, Rose, in November. We're currently making ends meet, so I'm not. We're making ends meet, so I'm not needing income from trading. I would like the numerous hours I spend on research to start producing some decent results. I know I am meant to be a trader. I currently work full time and I swing trade for an income with a current goal of $600 per month. I do my nightly and weekly research, record keeping, and can recognize patterns very well, and can sometimes 50% of the time my trades work well with the market, or well with the market. Pristine assisted me in writing my trading plan. I'm focused on one bullish and one bearish pattern. However, they do not seem to be producing much over the last few weeks. After reading Trading for a Living, I believe one improvement I can make is to start using stochastic indicators again. I used to use it when I first started learning about the markets, and when I started learning from you. It's something that Pristine really didn't encourage, but I know you really utilize it a lot. Pristine emphasizes that the price action is the best way to recognize a pattern, and I have an account with Interactive Brokers and a subscription to TC2000 charting software. Please review the attachments. Any guidance you can offer would be greatly appreciated. I know you're very busy. Sincerely, William. William, I read it. I love the picture of you and your family. I appreciate that, and I went over every one of your trades, and your trading plan, and what you got going on for yourself here. I just love the way you approach the market. You seem so dedicated, the way you have your trading plan out here, and this is so important. Talk about having a passion for doing something, that not taking no for an answer. I mean, you really outlined yourself with a tremendous trading plan here. And again, I went through it, and I'm going to break it down a little for you of some things that I spot. Your goals. First of all, you have monetary goals. Monetary goals, I found, are very hard to come. When you're talking monetary, you're looking for the market to give you a set monetary price, and you kind of stick into the market until you get that price. It's a goal, and what I found is that that leads you, that sets you up for a failure down the road somewhere or another, because it just does not. The market's doesn't work that way. The markets are always changing. The ranges are changing. It's not always going to be a whole number. A $600 monthly income is great for an overall trade. Overall, what you're planning out to need to survive, or what you want to have. But when you start breaking down your trades and say, I want to have $100 profit on each trade, that kind of sets you up for some trouble. So looking at it, it says my goals here: small $600 monthly income swing trading, $30 risk per trade, $60 average profit. This would require 40 trades at 50% success rate, 16 trades at 75% success rate. All right, $30 risk per trade is a very, when you talk about being a perfectionist, that is kind of that's a perfectionist. But I could also tell you that you're also trading with small shares. So if you're looking at you're trading 30, basically 30 shares, you're looking at a $1 stop, which is okay. I mean, you do what you have to do. So we're going to leave this as it is. This is not that bad. This is actually, the only thing I don't like is just the monetary goals as being set in stone. If the market gives you $47 and you're looking for $50, you end up staying in the market a little bit longer and it starts to pull back, and it could cause some trouble down the road. But you definitely have a good risk reward set up for each thing, and it's important to have this. Your scans, you break down everything, your bullish daily scans, your weekly scans, your bearish scans, again broken down into daily, and when you're going to do this. So you've really outlined your whole trading methodology, which is great. This really helps in keeping you focused. You have your patterns that you want to continue to look for, which is great. And these patterns fall across the many different things. When we talk about patterns, you'll see a bullish pattern be a bullish pattern on someone's chart because they have it in a certain certain indicators are telling you. But you'll notice something when we go over, I think, the key component that you're missing, that the setups work, but you have to add something to them. Imagine me trying to type this out. See, you can never type it out. I just want to sit here with my Starbucks coffee and just talk to you. I do it much better over the video because I hate talking on the phone. But anyway, I hope we can break down these trades for you. Let's see, my time frame. We break down your bullish time frame, and you have your entries here. And this is something that caught my eye. You'll be trading off the daily charts. For each position, I'll have a specific entry, stop loss, and target. For stocks price 15 to 30, my stop will be 10 cents. My stop loss will be 10 cents. Stocks price between 30 and 45 will have a 20-cent stop loss. So this is, this is pretty tight. This is very tight. You're kind of, putting yourself in a corner here with the volatility in this market. All right. For the bullish setups, I will enter my stop buy 5 cents above yesterday's high. All right. I will have my stop loss below yesterday's low. A target order will be placed in the next area of resistance in the daily chart in a large void. This is coming. There's a lot of this stuff is coming from old books. I could tell. You probably got a lot of. You've taken the courses with Pristine. You read a lot of books, and this is verbatim from a lot of books. Putting your buy target above the previous day's high. The stop. And that's, that works in some cases. You give me two examples where it does work. It doesn't work. But lots of times you talk about your scans here, and your scans right here for a bullish scan and a bearish scan. We'll talk about the bearish scan. You're looking for a, let me see if I got this. I'm on a right second. All right, 2 consecutive up days on a daily chart. So you're looking for a bearish setup as 2 consecutive up days. A bullish setup would be 2 consecutive down days, and I like that, but you kind of go against it here where you're talking about taking your trade into that bullish day. So you're already into that second bullish day and you're buying. So that's where you'd be looking for a bear setup. So you're kind of going against each other where, I think you'd probably, see in a bit how you could start looking for those pullback plays instead of chasing the market. You're already taking out the previous day's high. So you're buying into strength, but lots of times the market tends to pull back at that point. Usually it takes 2 to 3 days for the 60-minute stochastics to get overbought or oversold. So if you're taking a trade and you're already into the second day, there's a good shot that you don't have much more upside before you start to get some possible pullbacks. You have a nice checklist here. You could go over this, and there's a lot of things here. And again, we're going to go down to the money management, not risking more than $30. Utilize $2,400 of capital. I mean, this goes on and on. You won't hold more than 6 positions overnight, more than 4 positions over the weekend, 3 consecutive months trading 60% success rates. I would increase my risk position to $50 with a 150 stop profit target. Reward system, you want to take your Christine out for fancy dinner, and I love that. That's great. Seemed like a fantastic person. Continue education, you'll be watching DVDs, and you have everything written and broken down here. You got a lot of stuff here from Pristine. where they talk about the volatility index, the call ratios, equity, and these are their timing indicators. So you're using their timing indicators. All right, these are the ones I don't use. Breadth indicators are good. All these other indexes. Look at all these things you're using to determine buying and selling pressure. I mean, you have a lot of information that you're trying to refer to. When earlier in the video you said, the even pristine says that price action really shows you the direction of the trade, or really is the best indicator. Well, of course, and all these are going to work off of price action, and all these are going to line up probably the same based on that. So I think it's a little overwhelming, all your indicators. A lot of different indicators. It could get very confusing. Could get you could have a lot of conflicting stuff and make for the trade. So what we're going to do is, again, here's your routine. Turn off the TV. Very organized. I like it a lot. Everyone has their own little thing they need to do in the market to keep themselves focused and disciplined. And someone who's organized like that, has that type of personality, is perfectly fine. Now let's break down the trades. You also gave me your profit loss statement for the last 3 months. And what I did is I said, let's break these trades down. Let's see why you were successful, why you were not successful. See if we can put something together here. So we can notice that you usually carry small shares relative to 40, 30, 30, 30, 30. In some case, the lows here you had 100 shares. And you can see now, I'm just breaking these down. We're going to go through each one of them. You have some profits, you have some losses, but overall, by the end of 3 months, you came out with a $238 profit for 3 months. So you're not, you have some losses here, and you have some good trades. So we want to determine why the losses came in, and I think this is going to be the eye opener for you. All right. So we're going to break down each trade for you. All right, we're going to start with Nuva. Let's see. Let me bring up my charts now. I apologize, this is too long. I think it really comes down to this part of the video, and I've been talking about this for the last couple of weeks about high probability setups and having the discipline. And when it really comes down to is really seeing something. And this is a great example for me to use your profit and loss statements for the last 3 months and just go back and back test it. So there's something I'm not looking at. Have no bias opinions on this. We can look at them, see why it worked, and see why it didn't work, and see if everything lined up. So we're going to start with Nuva. Nuva, you were short 42 shares at 2013 on 9/28. And you made a profit, a nice profit of $100. The way that started off, you took profits. You don't have your cover area, but I can tell you you took profits. I can see the value go down. So you covered on 9/30. So two-day hold, and you can see it move down nice. You were in a nice downtrend here. Let's take a look at a 60-minute chart, and we're going to take a look at the 60-minute chart. And I think this is where you're really going to start to see something come together here. Here's their 928 level, and you can see we're overbought on the 60-minute stochastics. So the overbought 60-minute stochastics gives you that faster time frame to get your trades in. Overbought and oversold. So once you have a better, especially with the trend down, you have a nice opportunity to go short when you get this into an overbought level, and that's exactly what happened. So if you actually had a great entry here. Stochastics were overbought. You had a downtrend. Everything worked out. You took profits. Everything worked out good. You could take a look at the daily. And the daily, you can actually see the downtrending stochastics here. We weren't, the only place that we want to be very careful is when we get the extreme levels on the oversold. Once we're into this range here, we could refer back to the 60. Up here, it's not really giving us a signal. The signal's coming on the 60-minute chart, then the downtrending channel here, that's really playing out, really held up there. PKI, let's go to the next one. I'll run through these pretty fast. You had, again, another short at 9/28. That's September 28, 2011. And you had another nice profit. You took the short at 1975. And again, it was very similar to the other pattern. It was very, very similar to the other pattern. You have a nice downward channel. You took the short at the top part of the channel, and when that shows up, you probably see that showing up again on the 60-minute chart, the PKI overbought, excuse me, on the 60-minute, and a breakdown. Now looking back at this trade, and I'm glad that you get to look back at it, what does this really show you? It shows you it's a cash machine on the 60. Each time it comes down to that level, you know, it bounces, it moves. All right, it's not, you know, not giving us any big aggressive moves, but it's giving you that that directional move. It just is. And the same thing to the upside. You know, you get up to this level, up to this level, up to this level, up to this level, you're getting that move down. So you could profit either side. Now the problem is, if you're looking for, you're trading 30 shares and you're able to get a move on the 60-minute chart, if you're lucky, you get a good entry at say 1860, and you could get out at 1930. It's not bad. You're looking at 70 cents. But again, you're looking maybe at a profit. You're saying, well, I want to get I want to get so and so as a monetary profit, but the stochastics and timing indicators are telling you, wait, this is, we're not going to look for a monetary profit. We're going to take this trade here, and we're going to take it off when the indicator is getting a little overbought. And I don't care if it's a $60 profit or a $6 profit. When the indicator tells us to take it off, we take it off. All right. PKI. So good trade. I mean, you did take the indicator. It worked out. So you have 2 for 2 there. PSSI. Now, a lot of these stocks I don't trade. These are trades that, stocks that are very not they're kind of flying under the radar, probably lower cap stocks. Again, another short on that same day, 9/28, 36 shares. You take the short, I believe, is it a short? Yeah. At 2060, right here. You can see the stochastics on the 60 are pushing back down, and again, we did have that nice pushback. So you're in the right direction of the trade. So another good trade. Everything worked out fine. You actually paid attention to what I pay attention to. Next trade up here, the PXP. And again, what I want to do is try to stick to more of the known stocks. Something that's, give yourself a very good, when an index, give yourself a focus list of 40, 50 stocks that you want to follow, and instead of just doing your scans and getting these random stocks up that might be low volume stocks, stocks that you're just not familiar with, stick to stocks that you can trade over and over again in that time frame. Just make sure that you kind of be consistent with them. That way you follow them each time. It's not like you're just reinventing the wheel every week and trying to find something new to trade. PXP, Plains Exploration. You have a loss on this one. All right, you have a loss on this one. Let's take a look at it. PXP, 9049. So you were short here. You were short this one also, 913, and you got a loss of $34. So you probably took $1 loss on it about. Had 35 shares. So let's go out onto the chart. You're short 35 PXP. You're short 25,881 on 1013, and there's something a little setting up here on the 60-minute chart. Take a look at the 60-minute stochastics here. We were already getting close to oversold, and we got a crossover right when you took that short. There was a crossover on the stochastics, an upside move on the stochastics. Momentum was shifting, and you had a crossover, and the stochastics were actually heading up on the 60. You also had a very bullish trend. It wasn't a bearish trend. The other stocks, you were taking a nice short on a downtrending market. So when you got a nice move up and you get an overbought level, you had a good possibility of a further downside. Now you have an up. That trend is broken. Every pullback should be, it's a little bit different. If you're shorting a pullback on an uptrend, there's more likely you're going to get a bounce, and you need to be shorting the overbought stochastic. So this wasn't really set up. There was no real indicator setting up on this. It was kind of in the middle. If anything, it got the crossover. It looked like a positive scenario. So hence you weren't in the right position for that trade. That trade probably would have been a you know, there wouldn't have been a trade for that one. PXP, now the next one. ALR, and again you have a loss here of $32. Alright, ALR. Now, I took time to go over all these, so I kind of put down, hopefully I put these things down. ALR. Alright, this was one that, again, you're looking at a stock that's very choppy, very unorganized. It shouldn't be, you know, very 200,000 shares in the volume, daily average volume. It just does not look good, and it was just too volatile, and you got stopped out of it. It doesn't even come up on my 60-minute chart, so just not a you know, this is a reason you got lost. You know, kind of took a loss on this one. It's just you know, not a good stock that really pays attention to any rhythm or rhyme. And you know, light volume, you could spike around, and actually you were here going long here, or actually going short here. The stochastics embedded. It popped. It looked like there was some news here. You know, it came back down. It's pretty much a sideways stock. It should not be a stock to be traded anyway. Next stock, LPS, 71 shares. You looks like you were short on this one, but you only took a 50-cent profit. LPS. All right. And you probably, all right. So the daily, 1013, we pushed up here. Let's take a look at the 60-minute chart. There we go. All right, you were short here. The stochastics were overbought, so you were going against the 60-minute. You're going against the 60-minute stochastic indicator, and you can actually see that this didn't really break down. It actually broke down here a little, and then really got oversold and started rallying. I think you got out. You got out of this one lucky. You know, it was pretty much a flat trade. Probably broke down. You didn't take profits. What you were doing is holding this one. Looks like you were holding this. It's the LPS. You bought it at 1013. You sold it for 5. You were holding it for 5 days. So at this point, you were actually in it at 14.98. It came down to 14.34. You had a 50-cent, you know, 40-cent move on it, but you didn't take profits in it, and you let it come back, and pretty much you just got out even, and it would have went against you. So another thing is really establishing not a monetary profit area, but you know, when you see the stochastics go against you, then you should not be in that trade. So the pullback on the stochastics here on the 60-minute chart, really, you know, each time you see that level being, you know you're expecting a bounce, so you might as well take the profits into that. You know, this would have been a good trade, but you let it come back against you. Lows, L-O-W. LOW, let's see what we have. 100 shares, 22.84. You have a long, $140 profit. So let's take a look at it. Lows at 11.25. That's November 25th. November 25th. So here you go. Here was an oversold stochastic on the 60-minute chart. Perfect pullback, perfect entry. No reason why you shouldn't be long here. All right, so this was just a perfect entry on the lows. It was a very bullish stock. Actually, let's bring this out a little bit further. Here we go. You have a very good trending stock. So you want to use that 60-minute to your advantage. When it 60-minute lines up, there's probably a good shot that it stays within the channel and moves on up. So not giving you any daily setups, you know, which is fine. Daily would give you a high probability setup, but you know, go to that 60-minute chart, and you can see each time a 60-minute set up, you know, you had to bounce. Now, you got out. What was this here? Hello, 2022. This is your other trade. So you have 2 trades on this. All right. So you had 2 trades on this. Here's your first trade. Sorry, I actually have two trades down here on for you. So here it is. I don't want to get confused here. Oversold stochastics, push back up. There it is. That was the first one. The second trade, on lows, you took a loss. All right. I apologize. I'm just doing this as I am talking with you. We're going over this together. The second trade you took on 12/27/11, and you took a $31 loss on 48 shares. So let's take a look at that. Here is 12/27. You bought it at 25.68. Again, you're looking at, next time you have to give me if you're long or short. I have to do the calculations in my head just to see that. You're looking for a short here. No, we are looking for a long. Let me see what this is. You're looking for another long here. All right, you bought it at 25.68 and you had a long. But what happened was you bought it at the top of the 60-minute range. So you went against the stochastics and it got stopped out. Where you could look back at this and say, well, this is where I really want to buy. Always buy down here. Always buy here. Always buy here. You have a better chance in an uptrend. That's what I'm trying to explain. It's just, you know, out of all those indicators you're using, use a timing indicator and just make it logical. Say, all right, take the risk out of the trade. Yeah, he showed me every time we pull back down underneath this 20 level, there's a better chance of a bounce or an upside trade. If we're going to take a short, only take the shorts when they're up here. Anytime the trade's in between here, you know, you put a little more risk on. Anything can happen. And again, this is on the 16. I mean, this, you know, really, we talk about the daily setups too. Again, that last one you went. There we go. You went long here, and you should have been going short-term short, and you just got. I think you just got stopped out a little too fast. You know, you were only in it for a day. Over time, it worked out, but again, you know, your risk reward is a little tight, and you probably could have had a better entry just based on, you know, paying attention to the momentum indicators or the stochastic indicator right now. All right, please adapt this. Adapt this. You have a great trading plan. You know, you're working towards it, but this, I think, is really going to tie everything together. Let's just look at your next trade, because now we're starting to see the trades that are not working out are because you're taking it opposite the 60-minute stochastics. CTL. All right, you pretty much break even on that. CTL loss of $1.32. Again, holding it 11.28 to a couple days. CTL. Let's just take a look at it. All right, 2047 pulled back. So you had a long on this. It looks like CTL 47.12 a loss. All right, so you were going. Hold on. All right, so you were long here at 36.66 right in here, and again you're long. The stochastics were saying a little overbought already. Remember, you could be long here and take your profits off here, and instead you went long here, and you could see that drop down here, and it kind of shook you out, and nothing came of that trade. The next day it did pop on some whatever news that was, and then but later on it was very choppy. So again, I think again just going against the grain there, going against the 60-minute chart. RYL. Let's take a look at it. All right, you had a $31 profit. You were trading about 45 shares. Your buy was at 14.78. It was 66 to 93, so you were long. You held it about 3 days. 14.78. 14.78. RYL 1220. All right. I didn't mark that down, but you were long, and the long on the 60-minute was the correct entry there, just based off of that little pullback underneath the 20. That was a nice pullback. You had a nice run. Again, if you just took it from there to there, you would have got a nice little profit from here to here. Take it off. Not have to worry about anything. Just remember, continue to do that each time it sets up. You have a better opportunity for the directional trade. All right, that's as easy as it gets. You know, instead of all those other indicators, look back at the chart. You know, make sure that there's no outstanding volatile news out there. If the risk, step back, let the market calm itself, let it get into a rhythm. The rhythm is where you want to be. You want to be able to, you know, get in on the sold levels, you know, short on the overbought levels. Feel comfortable in the directional side of the trade. If it's a downward trend, upward trend, you know, trade the trend. RYL. So that was a good trade. A nice trade, 31.30. Next one was ARO. ARO. It's getting late here. Let's see. ARO. You took a loss on this, just 16 cents. Basically, you didn't give it an, you know, you had 46 shares, 15 to 45. Let's see, 711, 712, and you took a loss. It went against you, so you were short at 1545. 1545, you were short. What are you short here? Let me double check this here. All right, now I'm just looking at your, because you don't have a cover price here, you just have the date. So I'm looking at this. You got the stopped out flag. It's hard to tell if you were long or short, but I can tell you one thing: you probably should have been a short at this point, and you know, because of the stochastics being up here. If you were long, you had that grind out and you got stopped out. You looks like you were 1545 was your entry, and you took it off on the 27th. So you didn't really get any action on this at all. It's basically just got taken out of it. You got bored or whatever. If you were short, you just got out a little too early. And once I pulled back down into an oversold level, then you see that little bounce and it got overbought. And then you saw that little pullback. And what happened here, if you could just wait and recognize this as it sets up, that next time we're talking about getting into a position where we're looking at an oversold level on the 60-minute chart, and always referring back to the daily. And you can see the daily on 1222 right here, just getting back into an oversold level on the daily. So the combination of the 60 and the daily setting up really gives you a much better opportunity for a long there. So I like this long here better than here, or just trade overall here, because you have the daily and you have the 60 lining up here. Again, it was an okay short, but I don't know why didn't stick with it. But it wasn't a great setup. You know, you could have got a great setup on this. You could have just taken a directional trade with the indicator. Again, hard to see on that. Now you have a couple trades in Eastman Kodak, and you're trading 10 shares of Eastman Kodak at $3.21. I just recommend staying away from you know, cheap stocks like this, stocks that have a problem. You're actually trading 20 shares of Eastman Kodak at 64 cents. Seems like a you know, just kind of a waste of time. I know what you're doing. You're looking for that, you know, home run, or you know, you think there's a lot of risk there, and you're cutting back on your shares, and you should do that, and that's okay. You know, it's what you're doing. But you know, the more you stay away from the higher risk volatile stocks and stick to the more quality stocks, and taking, you know, and defining your indicators and defining your entries a little more tighter using the 60-minute and the 15-minute. I want to, you know, I want to hook you up with the I want to get you back on the 10 for 1,000 watch list, because the last this week's video is really good, and it really explains the concept of time frame layovers. So laying over the time frame, laying over the 60 to the 15, to the daily, and having those all line up and really takes the risk out and really brings the probability up. So when you're looking at higher probabilities and percentage of trades to work out, and then you have to do that. You have to add that to your ammo box there. You got to take a lot of that other stuff off of that, all these other indicators you have, and make it and simplify it a little. Safeway, looks like you had a $21 profit, 14.10 to 14.33, so you're long at 20.73. So SWY, and I like Safeway. Safeway's a good stock. And what we're doing here, it's 20.73 on 12.22. All right, you've got a profit of 21.80 here. Looks like you're long 20.73 and 12.22. I don't see the price level here unless there was a pre-market buy or something. But either way, 12.73, $21, 68 shares. It's not the best setup. I think when you're going to be looking at your entries a little bit more, concentrate on taking the best of the best setups and giving yourself a little better opportunity of getting in and out. So you want to recognize a couple main things on the charts: the coil stochastic indicator. Whenever you see it and you get oversold on it, that's probably one of your best areas to entry, and this is one of your best exit, and you get a much better return than not getting a good setup here. I mean, even though you are getting overbought here on the 60, but it says you're long here, and it shows you that we're overbought, but we didn't get any action on here, and it's just not a it just didn't really pan out too good. It's real choppy. There was a good setup here, coil stochastics downward. Everything else worked out pretty good on the daily. You could look back at this and say, well, there's a couple really good daily setups, and these are the ones you really want to capture and have a little more tolerance with. These tend to play out much better. Again, stick to the 60-minute daily layover. So when the 60-minute and the daily both line up, and also go down to the 15-minute to again exact your entries. And we're going to go to one, I think another one, and let's see, NIHD. And you took a loss here, $6 and change. NIHD, 42 shares at 12.28, 20.70. Went against you, so it went up in value, so you were short at 20.70. So here's short at 20.70. But what did you do here? You went short as the 60-minute stochastics were oversold. So of course you got a nice bounce off the 60-minute stochastic. So that was an easy to see what went wrong there. Again, you should be short always here, long always here, unless there's there's news out there and there's a real bullish trending stock. But in a stock that's just rotating in and out of its levels, stock will move up and then move down. Remember, instead of where you're saying sometimes taking the trade above recent day high, and then what happens is it comes back down underneath that, so it chops around. I'd rather see you get in on the oversold stochastics and get out here and not worry about getting in on strength. You're getting in on when the indicators are letting you know, letting you set up here. Again, as you get close back down here into the oversold level, again you can see another nice pop. If something doesn't add up for some reason, then stay away. It's as simple as that. Stick to a good focus list. Like I put out the HPS 40 now, which is just the purpose is to keep you in a group of stocks to really not get you scattered out there, to really keep the discipline intact, continue to rotate in and out of a stock, see it before it happens, and you mentioned all this in your trading plans. I think it's great to see it before it happens. The last stock you have up here is ARCO. I know this stock a lot. Again, you were short. You actually got a nice little profit on this. You were short 20.98. And again, here's an example of being short when the stochastics are overbought, and that's the right thing to do. So of course you got a nice short here, and you took profits into it, and it was a good trade. So I would say, going back to the ones that you've noticed that you didn't have profits on it, you took trades that are opposite the stochastic 60-minute chart. I think that was probably the majority of those. The other ones weren't really good stocks to be in, or liquid stocks, cheap stocks. The Eastman Kodak, you took 2 losses on that. That could be eliminated. All right, that could definitely be eliminated. The Safeway was great. It was a perfect setup. NIHD, you went against the stochastics. ARCO, you went with the stochastics. It was very easy to see that. These who went with it, CTL, pretty much got chopped out. Lowe's, all right, where you had the great trade on Lowe's, 2 trades on Lowe's. Let's just break that Lowe's down once again, because that's my favorite stock on your list of stocks. It's a recognizable stock. All right, Lowe's, your first trade was at 22.84, and you were long at 11.20 on 11.25. So 11.25, you're oversold on the stochastics on the 60-minute chart, and you have a beautiful run there. All right, your second trade on that was 12.27.11, and you took a loss on that, and it looks like you were long also, right? We were long also, and that was on 12.27 right here, and you were long right here. So this is where you were long, by 25.68. You're long right here. But what's this? Stochastics are overbought. So of course you get that pullback into that channel, and you get stopped out. So the Lowe's is really the key stock right now that shows you the difference between your successful trade and the trade that didn't work out. And it was very easy and obvious to see if you have changed that and just taken the trade, with the stochastics behind your back. Also, understand that you have the daily that eventually lines up too. You're on a trade to trend. You want to make sure news is in your favor. And most of all, don't put a monetary profit on every trade. If break it down to the 60-minute chart. If you're going to take your entry on that, take your exit on that too. If you start to see that the stochastics are starting to run up here, and you're not getting any further move, and you don't want to hang out there until you get stopped out, just take it off. Move to the next setup, because what you're doing is you're looking for that, that 70%, trading record, and over time this will give you that. But if you stay in a stock too much, eventually you'll get stopped out, and it'll start eating away at the profits. So don't let them, just be more disciplined in taking the profits off. I think that really is a big difference. I remember, it's funny because I like the picture of your kid, and it's nice. I have a little baby too, and I remember when I had my first kid, and I was like, wow, this is a big change. I could really define myself as stepping up the game on my trading, where I really started taking more profits out of the market because I had more responsibility, instead of being a little more, I always called it cavalier, and a little more as the gambler would do. Because in the market we have so much emotion that we have that fear now. You have that fear of, you don't want to lose the money you have. You want to support your family. You want to pay the bills. You want to be successful in any case. But yet you overthink the process. You have too many things on the you're doing, research is great, but doing too much and getting too much involved on everything and having all these indicators could really confuse you, when it really comes down to a simple process of a scientific approach where, follow the trend, until that trend breaks down, buy on the pullbacks, short into the strength, but use the stochastics to break that down. Use the labor effect of the daily 60, 15-minute chart, and stick to a good focused round, focused group of stocks, you know, like the HP40. All right. Other than that, I really appreciate your email. It was good to hear from you, William, and good luck in your trading. All right. Hope I helped you, and feel free to just, you know, fire me back an email. I hope this saves. This is 45 minutes, and it's God, it's like talking on the phone. Take care.